If you've ever looked into commercial real estate investing and felt completely lost, cap rates are probably why. It sounds like finance jargon, but once you get it, it's actually one of the simplest and most powerful tools in real estate. And after this video, you'll understand it better than most adults who've been in the industry for years. Let's get into it. Cap rate stands for capitalization rate. It's a percentage that tells you how much income a property generates relative to its value. The formula is simple. Cap rate equals net operating income divided by property value. That's it. Two numbers, one percentage. Let's make it real. Say you're looking at a small office building. It brings in $100,000 a year in rent. After expenses, maintenance, insurance, property taxes, management fees, you're left with $80,000. That's your net operating income, or NOI. The building is listed for $1 million. $80,000 divided by $1 million equals 0.08, or an 8% cap rate. So what does that number actually mean? Think of it like this. If you bought the building in cash, no mortgage, an 8% cap rate means you'd earn back 8% of your purchase price every year from income alone. It's basically the return on your investment, assuming you paid all cash. Higher cap rate means more income relative to price. Higher return, but usually more risk. Lower cap rate means less income relative to price. Lower return, but usually a safer, more stable asset. A trophy office building in Manhattan might trade at a 4% cap rate. A strip mall in a rural town might trade at a 9 or 10% cap rate. Same concept, completely different risk profiles.
Why do investors care so much about cap rates? Because it lets you compare completely different properties in seconds. Without cap rates, how do you compare a $2 million warehouse in Charlotte to a $5 million retail center in Atlanta? They're different sizes, different cities, different tenants. You can't just compare prices. But if the warehouse has a 7% cap rate and the retail center has a 5% cap rate, now you have a conversation. The warehouse generates more income per dollar invested. Is the extra return worth the extra risk? That's the question every deal comes down to. Cap rates are also how brokers price properties. If similar buildings in a market are selling at a 6% cap rate, and your building has $500,000 in NOI, the implied value is about $8.3 million. That's how valuations work in commercial real estate. Now here's one thing most people get wrong: a lower cap rate doesn't mean a bad deal. New investors see a 4% cap rate and think that's a terrible return. But a 4% cap rate in a Class A market usually means the asset is stable, the tenants are strong, and there's very low risk of income dropping. Institutional investors, pension funds, REITs, insurance companies pay low cap rates all the time because they're buying certainty. Meanwhile, a 10% cap rate sounds amazing until you realize the anchor tenant is leaving next year and the roof needs replacing. Cap rate tells you the income story. It doesn't tell you the whole story. You still have to understand the market, the tenants, the lease structure, and the condition of the asset. Here's the one sentence you need to remember: cap rate is net operating income divided by value. It tells you the yield on a property as if you paid all cash. High cap rate means more return and more risk. Low cap rate means less return and less risk. That's it. Once you understand that, you can walk into any conversation about commercial real estate and actually follow along. And if you want to go deeper, NOI, debt coverage ratios, how brokers actually structure deals, that's what this channel is for. Subscribe and I'll see you in the next one.